And welcome everybody, it's James and Lex from the Academy with the September club meeting. I just got off a plane a couple of hours ago, just walked in about 15 minutes ago. James has as usual, done all the work preparing the meeting. So James, what are we going to talk about this month?
There's lots to cover, so why don't we get started rather than dwelling. So we like to kick off with a quote to begin with, and this is going to frame the beginning of today's conversation and presentation. So it was anonymously sourced, a portfolio manager who I was speaking to at a hedge fund, who posed the question that the S&P 500 doesn't represent the real economy. So if you were to look at GDP growth, retail sales, industrial production, all of which have been weak, and then QE, if you were to make the stimulus argument, which leveled off in 2014, none of that really explains why US equities should be making all-time highs. So this is an interesting quote in its own right, at least for me it was, and it's something I did some research into. However, as it relates to the start of this presentation, what we're going to do is really analyse, using the process from the course that we teach within 5-Step Trading. We really need to understand the US economy and look at other regions as well before you can go making a judgment of how healthy or how good things are simply by looking, at the headlines where they say stocks are all-time highs in the US and that sort of thing. You trade currencies that way. You would expect the dollar index to be at all-time highs. It certainly isn't as we record this, and you would expect commodities to be booming, which, whilst they have rallied this year, they're certainly not at highs, secular highs.
Okay, so we're going to look at the different factors that we look at in the currency trading course, 5-step currencies. So we're going to go through each of those, and I guess we'll start with the US. And when you trade currencies, the economy is even more relevant than when you trade stocks. So let's have a look. I guess here you've done it for the US, and you've looked at the government bit. So what do we see here?
We're going to look at government, industry, country, and consumer.
So that's exactly the same as is being demonstrated in the course, right?
Yeah, that's right. So we thought that it would be useful. Many of you have taken the course that are club members, but for those of you that haven't, I think it's useful to understand the process that we follow as well, month to month, when we're discussing themes in the club, and not simply, kind of take what we say for granted as though we just plucked it out of thin air. So we want to explain this. So the two things that we look at within the government category are debt relative to GDP, which you can see for the US is climbing and is projected to increase as well, both next year and to a 2020 horizon. And also the budget balance, so the deficit, is likely to deepen in magnitude in terms of the deficit. It's likely to grow through to 2017, but by 2020, analysts or economists expect us to be back to roughly where we are at negative 2.5%.
Okay, I mean, what this tells me is that, there's not going to be much change between now and 2020, both in budget balance, not getting worse, even a little bit better, and debt as percent of GDP, okay, marginally worse, which is not a big surprise with negative budget balance. But there's not much in there to drive the dollar. So from a government perspective, dollar shouldn't change that much.
So let's take a look at the charts. So we'll do this for each of the categories, so we don't spend too long on each. So debt to GDP, you can see now since 1980, before I was born, it's been in a steady uptrend. It did get addressed in the mid 90s, but the overall trend from 1980 onwards has been upwards, and this is typical of developed markets or developed nations broadly, but the US has certainly been no different.
Yeah, and the only time that was as a percent of GDP was worse was World War II, after which obviously the economy exploded in growth, and now it's not likely that GDP growth is going to bail us out in the future. So there's clearly a big issue. However, as a currency trader day to day, we're just above 100%. So okay, that's where we are right now. And the budget balance actually quite positive. It's been much worse 5-6 years ago, and it's slightly steadily improving. one of the reasons, I guess, is that
The fiscal cliff as well in 2012. All of the worry about that, where they thought they were going to collapse under their own.
Yeah. So I think
things were addressed a little bit politically then.
Yeah, and as the economy has sort of slightly improved over those years, the tax revenues, etc., have come in better. So budget balance has.
Speaking of tax revenues, that's definitely a chart to look at. That's current tax receipts in the US. If you look at the year-over-year change, they're really, really falling now.
Right.
The momentum is frightening.
Right.
It's certainly a recessionary indicator. But that's not the point of what we're going through here. It's not to kind of impose our view on it. We're just going to kind of clinically analyse each of the categories here and provide comment.
Yeah. Okay. So then the second part we looked at the government. Now we look at what's the industry doing.